Welcome to this episode number 69 of your next trade, called today La France a peur. So this week in the US we have seen the same story as before, which is stocks going higher, S&P, Nasdaq, semiconductors, Nvidia, Apple, Microsoft, all those names going up, Russell coming down. And in Europe we had a bit of a change. Why? Because last weekend President Macron decided to go for the dissolution of the parliament, and the reaction from the market was not that great, and that's an understatement. So if we look at the CAC 40, the CAC 40 here, as we can see on the week, the CAC is down more than 6%. But what is really important is the market is very much driven most of the time by the credit market. And if we look at credit, if we look at the spreads between the German 10 years, which is the Bund, and the French 10 years, which is the OAT, we went from 50 bips difference to more than 70 bips. So for those of you who have been trading for more than 3 years, you might remember that, in 2011, 2012, we had the European crisis, which was mostly about Portugal, about Italy, about Greece. But when we saw the spreads between the benchmark, which is the German Bund, the 10 years, and any other 10 years. So this is what we have recorded for the week. The market is very much in Europe scared of those recent events, and more specifically that the President Macron decided to go for the dissolution of the parliament. Again, same as a trend, the trends of populism in Europe, in the world over the last 25 years is pretty much obvious. So you can be putting the blame on Macron and saying, he should not have done that, he's gambling. I don't think this is the case. We have 50% in Europe, 50% of the people in France that have been either voting for the far left, or the far right. So 50% is one of the two. And the big election was coming soon in France in 2027 for the presidential. So the trend is the same, and if there is no change, if there is no reaction, don't get me wrong, populism, people start or try to forget what happened in the past. I don't think this is really the solution, but this is my view only. But let's go back into the market. So we have seen some tension in Europe, so volatility going higher. But in the US, the trend is still the same. Year-to-date asset performance for the S&P now is at 14%, almost 18% for the Nasdaq. The Russell is down on the year. So for all of those gurus who have been telling you, okay, buy the Russell because this market will be broadening, that is not the case. It's again driven by very few names again and again, and the trend is still the same. What about Europe now? For Europe, if you look at the Euro stocks, we are only single digits, 7%. Japan is up 16%. And then for the FX, crypto, and finally commodities that are still up nicely. What about the week-to-date asset performance? And here you see a big divergence. So what we have seen over the last 18 months is most indexes, equity indexes, stocks indexes, were moving the same if they were adjusted from currencies. So if you look at the Nasdaq, if you look at the S&P, if you look at Japan, if you look at Europe, they were all following the same trend, like almost, the beta was 1. But for the last 5 days, actually, we've seen a divergence between US, which has been doing very well, and Europe that has been down. So Europe, Euro stocks down 4%. As I said, the CAC 40 for France was down 6%. So it's very much the same as 2011, when the first reaction is when you start to see, as an investor, some trouble in one of the regions, you're putting out some of your money and you're reallocating your money to the US. And US have been seeing some inflows based on these outflows for Europe, because you don't want to have exposure, or you want to reduce exposure to Europe. Interestingly, the risk off as well for Bitcoin, crypto, and a bit of okay week for WTI gold. What about the year-to-date industry's performance? And here, we have this big winner. We are talking semiconductor that is up down more than 50%. So very much, again, market driven by very few names. And this is even more interesting if we look at the week-to-date, where you're going to have the Nasdaq, the S&P here, and the Nasdaq that is here. You can see that very few industries are up on the week, and tons of industries that are down on the week. So very much, I'm pretty sure that if you've been on Twitter or social media, that you've seen that this market is driven by very few names. That is really more and more the case. So the sector performance, this chart, this one is telling you a lot, because you see IT technology is up almost 6% on the week. But this is really like 3 times more than, or 4 times more than the second one, which will be real estate. So again, similar story, very much driven by very few names. So what about the US 10 years? 422, we are down 20 bips on the week. Why? Because we had the CPI. So the CPI that was lower than expected. Both the headline and the core CPI in the market lacked it pretty much. For all the macro guys as well that have been trying to play the steepening of the yield curve, that has been a fail. So tough market if you've been trying to be smart, unless you've been playing those very few names and you've been playing the trend. What about the Fed funds rate? So instead of looking at the target rate, the Fed fund rates and what was the last level, which was 5.33, I'm putting the target rate of 5.50. And if you compare the 5.50 with what is the last at 4.94, you get a differential of roughly 50 bips. So the market right now is pricing 2 cuts in 2024 versus the FOMC dots. What are the FOMC dots? This is what the different participants of the Federal Reserves are saying, are telling us and sharing the expectations of the cuts or no cuts for the next few months. And market is at minus 50 bips when Fed is saying minus 25 bips. So a bit of a difference. But what you can see, since we started the rally at the end of April, start of May in stocks, you can see that the red trend here is going into the last, which is here. So everything that is after December 2024, here you have more and more dovish expectations from the Fed, which is more or less saying that they'll be cutting the rates much quicker than what we were thinking 6 weeks ago. So going into the VIX volatility, same story. Volatility is absolutely destroyed, 12.6%. So we are around the 12%. So very much like quiet market in terms of expectations. I don't think that many market participants are expecting a summer that will be moving. And that is interesting, because that goes back same as 2011, when the market was saying, okay, I don't really care about Italy, I don't really care about Portugal, because that's so far away from the US. Then because the spreads widened so much, then the market had to care. So if you look at 2011, go back into there and see how the S&P did in the summer 2011, and you'll be pretty much surprised. So if we go back into the French elections, we have the French election on the 1st, so that will be start of July, and then the second round on the 8th of July. So that gives us another 3 weeks of potential volatility, and plus, depending on the results, you can expect more volatility. So that means on one hand, you get the US kind of saying, I don't care about anything, and Europe that is starting to be firing up. So what about the chart? Looking at, and we're going to be starting with the CAC 40, with the French one. As you can see, we gave up all of the performance for the year almost. So we are back into 7,500. This is the trend that started since 2020. You do have like another potentially, 10% easy for the market to go down before something happen. And I want to flag as well the DAX. So I've been pretty clear. That is probably one of the few that I had right on the DAX. So the channel is working pretty well. This is a weekly chart. As you can see, we tested the high of this trend, and since then we have been coming back. So what about the US S&P story? Still the same. It's pretty an aggressive, very strong candle for the week versus the European candle. This is the same with the Nasdaq, where we're going to be testing soon this trend here. And I want to be again flagging the Russell. Too many people, too many retail traders have been following some gurus and losing money on the Russell. I think after the CPI, everyone was like, "Oh, I'm long call on the Russell." It didn't last that long, and we gave up all the performance 2 days later. What about the those drivers, the meta of this world, you can see if you do a bit of dodgy technical analysis, and sometimes, you know, up, if you do this, up, so that's probably something like this, up. Can I do some, where is my trend? I'm using Bloomberg most of the time, but you will have, okay, this is the one, up. This is what you have, okay? So we are trending up for all those names. Oil, not much of a view, it's trading sideways. Copper has been giving up some of its performance. We are talking 50%. The candles are not looking great so far. And euro dollar has been a tough week, 107, but actually euro has been doing pretty okay versus the spreads that we see in credits and the stock market. So euro has not been it has been underperforming, but versus the other asset classes have been doing pretty okayish. Dollar yen, another one where we had the Bank of Japan on Friday. We kind of say we're going to do something. We don't know what we're going to do it. We don't know the size of it. So they're going to reduce probably the size of buying bonds. They might do hiking rates. We don't know what they're going to do. So the market is in wait and see position with, in the meantime, the carry that is going against the Japanese yen. So let's go back into our Excel spreadsheet, looking at what happened for the week. So starting with the S&P futures last 5 sessions, and the big move has been here. And if you've been trading the market, you've seen just after the CPI, which was on Wednesday. So the CPI came lower than expected at 0.16 for the core month on month versus 0.3 expected. But to show you the craziness of this market, we didn't trade on the futures, on the S&P futures, around like 20 points. So we went from, I think it was 53.95 to 54.15 without any tick. So that tells you about the bad liquidity of this market, that this market is very much you don't have any market makers for the almost like when the market is moving. So S&P very strong. So for the week we moved up, consolidation, we move and we consolidate. Why? Because the Fed as well said we only gonna have one cut in 2024. So that was a bit of the volatility that we had at the end of the Wednesday session, but not that much, not much of volatility. As I said, the Bank of Japan was another one, not much happening. Many stock havens. So we started, this is something that we flagged last weekend. We say on Monday that Apple will be coming with this presentation. So the first reaction on Monday was pretty weak, where the stock came down from 196 to 193. Then Tuesday, Wednesday, big move. I listened to part of this presentation. There was nothing really very sexy, but as always, sell side then on the day after said, there are a lot of good drivers, lot of good catalysts expected for the next few years, and the market rallied. But mostly, as always, what happens is the market is driven by options. So here, if we look at that chart, this is the call options that were traded on Apple over the day of Tuesday and Wednesday, mostly, where we had 3 million and 4 million roughly of call options. And guess what? When you get so many call options, they're driving the delta, the gamma that pushes the underlying, and we went from 200 to 220. So we went literally, if you look at the chart, we went from one strike to another, and those strikes were $2.5 away. So we went from 200 to 205 to 205. And so on. So, and then we gave back a bit, but that tells you that again the market is very much driven by those options. Actually, if you look at the SPY, volume, it's coming down, and the trend is lower. So less and less participation, and participation into very few names. Nvidia, after the split on Monday, is up 10% for the week. 10% for the week. Tesla try to be up, but it's a bit of a struggle because so far, market is struggling to find any catalysts. And finally, looking at the core CPI, so we are trending lower. If you think here, this is the 2% target of the FOMC, of the Fed. So when the Fed is telling you that they are very much limiting the access to credit, that they are actually, you can tell we're looking at the core CPI that we are still far away from the target, but both the ECB, the Fed are now telling us that they are okay to run the inflation hotter for the next 18 months. So probably the target will be reached at the end of 2025, start of 2026. So what about the catalyst going forward? First thing first, on Wednesday, the US market is closed. So that means we have only 4 days of trading for the week. Instead of having the VIX expiry for the futures on Wednesday, it is happening on Tuesday. So a bit of a change. And we have the options expiry, the triple witching on Friday. So what happened most recently on the OPEX week, not much of a clear signal, but what we could expect is a bit of a reset after the expiry, especially after those big moves that we see on the big names. So for the big names, this is here, I'm looking at first, this is the semiconductor, SMH. I'm looking at the SPY and the QQQ, which are trending the same. And finally, I'm talking at the equal weight. So again, we all know about the market breadth. We all know that this market is driven by 10 names, and those names are so big that they are pushing the market higher. Underneath that, the market is not that strong, and it tells you that either you are in these names and you're making good money, and if you're not, then it's a bit of a struggle. In terms of macro, as always, I'm looking at the retail sales. On Tuesday, the expectations are for plus 0.3 expectations. We got the flash PMIs on Friday. And finally, obviously, I'm always looking at what are the expectations for the weekly move on the S&P. So that's plus minus 1%. So very much like similar to the implied volatility that we had through the VIX. Not much of expectations. So retail sales, OPEX, flash PMIs, and as always now, starting for the next 2 to 3 weeks, we're going to have more volatility in Europe. So I will be looking at the French 10 years and the German 10 years, but as well I'll be looking at the BTP, which is for Italy, and how the different banks will be trading. So far the ECB has been saying, we're not panicking, we are fine. We do know how the central banks do things. They panic when it's probably too late. So we'll see how far the market will be pushing those spreads and will force the ECB to intervene. But otherwise, market is the same. I'm talking equity. Market is the same, driven by the same story. The big move for the week has been for the 10 years, the 2 years in the US to come down quite massively. So if you think about the correlation between bonds and stocks, that has been working pretty well. When your US 10 years goes from 440 to 420, that helps the stocks to go higher. This is that for the catalyst for the week. If you have any questions, you can reach me. You can send me an email. You can join us on the Discord community. I hope you're going to have a good trading week, and I'll see you next week. Bye bye.